Welcome back. The three major indices on the street all posted modest gains on Thursday after weekly jobless claims reached their lowest level since the start of the COVID-19 pandemic. For the session, the Dow jumped 0.4%, lifted by Walgreens and Chevron, while the S&P 500 gained 0.3% as it hits a 54th record closing highs of 2021. And the tech-heavy Nasdaq recorded consecutive closing highs as it advanced 0.1%, while helping prop up the market was jobless claims data that came out before the opening bell. It showed that weekly claims had fallen to 340,000, the lowest level since March 2020. Well, investors will now look forward to Friday's key August jobs report for further clues on the Fed's monetary policy plans. Of course, to help us understand about the future jobs outlook, we're joined by Thomas Hayes, Chairman and Managing Member with Great Hill Capital. Of course, Thomas speaking to us this evening from New York City. A very good evening to you, Thomas. So we are just picking up on the note of the better than expected market performance. We are seeing actually the S&P 500 chalking up a pretty long period of solid gains since November. So that is warding off some of the negative impacts, for example, like the fluctuation of the treasury yields and also the bubble burst of the clean energy stocks and also Delta variant. So what's driving the performance?
Yeah, so I think what you're seeing, number one, is earnings are the name of the game. Just a few months ago, if we looked at 2022 earnings estimates for the S&P 500, people were expecting in the neighborhood of $200, a little over $200. Now it's at $220, and we think by the end of the year, those earnings expectations will go up to $230 for the S&P. So there's a fundamental underpinning that the earnings are growing for the S&P 500. But some people, you pointed to 54 all-time highs this year, and some participants are looking at that as a reason that we're extended and that we should correct. And the fundamentals just don't support that. If you look through history, strength tends to get strength when you're up 20% through August historically. What you find is that the end of the year finishes positively on average as well. So things are pointing to positive signs. The big data point is tomorrow morning with the jobs report. And this could be very, very interesting as it relates to the Fed's decision on when to taper. Expectations are to create 750,000 new jobs in August. We think this might come in a little bit lighter than expected based on what we saw in the ADP report earlier this week. And if so, that would give the Fed cover to delay the announcement of taper from September to November and have implementation end of this year or early next year versus what people had been thinking possibly October in recent weeks.
Mm-hmm. Well, in the meantime, we noticed that September has been seasonally a lackluster month for the stock market. But right now we are seeing a pretty positive start for this time around. So what's your prediction to this September?
Yeah, so, you have a number of things happening with pent-up demand. Certainly, Delta is going to have an impact on the jobs number, we think, tomorrow. But you are going to have a pent-up demand with inventory rebuilds, capital expenditures coming from corporations. And obviously, we have this infrastructure bill hanging out there, which would be approximately $1.2 trillion of hard infrastructure and another $3.5 trillion of infrastructure / social spending, which would add an enormous amount of short-term stimulus into the economy. So I think with that hanging out there, with the amount of liquidity in the system, the money supply expansion over the last 12 to 24 months, it's hard to get too bearish until the Fed starts to take the punch bowl away. And tomorrow's report is going to determine, is the Fed going to take the punch bowl away immediately, or is it going to be pushed off closer to the end of the year, early next year? And if that's the case, I think the correction that people are looking for in September is more likely to come sometime early next year, have an early cycle correction. But in the interim, things really do look strong in terms of the recovery, in terms of the data. We looked at total product demand for energy came in the most recent report this week at an all-time high in the United States. So people want to get out despite this overhang of Delta. They want to get back to their lives. Business is booming again. And we think the fundamentals are intact through the end of the year.
And then what's your prediction on the future trend of the US dollar? Do you think the weakness will continue?
Yeah, I think in the short term, you're entering a seasonally weak part of the year. If you look at the average over the last 20 years for the U.S. dollar, it tends to be weak in the August, September, October range. So we think this short-term weakness you're seeing could persist in coming months, and you're seeing the impact of that also in terms of oil. Obviously, you have the supply-demand equation, but a weak dollar as oil is denominated in U.S. dollars helps oil prices move higher. And we've been seeing commercial hedgers have been buying oil in recent weeks, and they tend to be early and they tend to be right. So I think this short-term trend of oil getting a bounce and the dollar getting a little weakness should persist in coming weeks. And we think, particularly as it relates to energy stocks, that they represent an opportunity in coming weeks to buy on weakness as they've sold off in the last 4 to 6 weeks. And we think they represent a tremendous opportunity as certainly leisure travel has come back quite a bit. But as business travel slowly comes back in coming months and over the next 6 months to 12 months for sure, there's an opportunity there.
Of course, we'll be closely tracking those sectors. Thank you so much indeed, Thomas, for your insight. That's Thomas Hayes, Chairman and Managing Member with Great Hill Capital, speaking to us from New York City.